Welcome, everyone. It's good to be with you all. And special welcome to our guest, Peter Blom. Peter's joining us from his holiday vacation on the north coast of Amsterdam of Holland. So really appreciate your time on this, Peter. Many of you probably know Peter or who he is. I'll give a brief introduction. He's and in fact, I just learned he was actually at Triodos at the beginning in 1980. So literally spent his entire career at Triodos Bank, rising up to become the CEO by 1997, and ran the bank until a couple of years ago. And so during that time, Triodos Bank really became the kind of poster child of what sustainable banking, or to use their phrase, values-based banking, is about. And I've been fortunate to get to know Peter over many years now, and we're both now working on a project together at the Club of Rome. So I can't think of anyone better to talk about banking than a legitimate banker, unlike myself, who spent most of my time in capital markets and venture capital kinds of things. So again, welcome, Peter, and thanks for joining us.
Thank you for having me.
Just to remind everyone, and for the folks that are not in our course community, we do these discovery dialogues for the broad public once a month, and we try to pick a theme that is in the news, a topic that's in the news, and look at the issue through a regenerative lens. So we're not going to just rehash what you can read in the newspaper. We're going to try to understand it through the insights of looking at it through a living systems framework. And for those of you that are in our finance course right now, this topic, banking and the most recent banking crisis, is a little bit ahead of the agenda. We're not going to get to banking and money until the second half of the course, but this event is very timely. So tuck this away for the second half of the course. And again, just as a refresher for those that aren't familiar with our community, the idea of these dialogues is it's rooted in there's a short little book called On Dialogue by David Bohm, and he explains that, and he was a world-class physicist, and he explains the importance of dialogue. The word, first of all, die, the die part of the word actually means through, not to. So it's not a conversation between two people. It's creating new meaning through understanding. And so Peter and I are going to start in dialogue, and then we're going to bring you all into that dialogue. And the hope is that all of us learn something that none of us knew coming into the conversation. So with that, the topic today, as I mentioned, is the most recent banking crisis in the United States. 3 or 4 banks effectively went bankrupt and had to either be rescued by the bank regulators in the case of Silicon Valley Bank, or taken over by other banks in order to avoid failure. And I guess that actually happened in March. There was sort of a domino effect, and things have quieted down since. But it did, it sort of, in one sense, came out of the blue. We thought we had gotten through the bank crises, and of course, they were all related to the sudden and very rapid rise of interest rates orchestrated by the world's central banks and led by the U.S. central bank. And so it's a reminder that, everything's connected to everything. And, when you have such a shock, you're likely to see consequences. And the gist of it was that Silicon Valley Bank's bond portfolio lost more money on a mark-to-market basis. In other words, its market value dropped by more than the capital of the bank. And not that they needed to book that loss, but that extreme loss essentially triggered a run on the bank. And so what I'd like to explore today, Peter, with you is really just to kind of think afresh about the whole banking system and the business model, And maybe, from your perspective, let's just start with your thoughts at the time when you watched the Silicon Valley Bank crisis unfold. Like, what were you thinking? And by the way, I should also mention Peter is now on the central bank board for the bank, the Central Bank of the Netherlands. So he's got a very interesting perspective into the banking system, both as a practitioner for his career and currently as a central bank governor. So anyway, let's start with just what were you thinking when you watched that unfold, Peter?
Well, my response was on different levels. First of all, I thought, how is this possible? Because I know regulators, and I'm now close to a regulator myself, and this is something what a regulator should see coming, because there's a real risk in the balance sheet of that bank by the differences in interest rates on the debit and the credit side. Actually, quite a simple example of how you can have a mismatch. And if something grows very quickly on the one side and not on the other side, you really have an issue. So what I learned then, I didn't know, but I learned more from the papers, that actually happened under Trump. He sort of made this sort of strict regulation less applicable for that size of banks. And the size of the bank is, particularly in Europe, so the bank I have been leading was only 23 billion, and they were more than 250 billion. So I wondered how come technically. But maybe more interesting is if you look at the whole banking landscape, how is this possible again, and how come that we did not learn that in difficult times, volatile times, banking is a very lucrative business. Because if you make profit, it goes to the shareholders, you privatize the profit, and you socialize the losses. And that sounds like, how come? How is that possible? But that's still happening.
Yeah.
And actually that happened again. And I think that is one of the core issues in the financial system, that you are not as a simple private business. You have a very important societal role. And if things go wrong, the government, on behalf of the citizens, have to make sure that you will continue to function, or at least the others function. On the other hand, you also want to, in a way, let the shareholders really take the risks they took. And that sort of imbalance in the system is still there. And and it will be one of the big questions for the future for the financial system. How are we going to deal with that? What is a bank? Should it be a complete government bank, or should it be private but then much smaller? Or is it something in the middle? And then the whole question is that more the commons or something like that? So there is a sort of technical question I had, and there is a more fundamental question of what is happening in the financial sector and what should happen.
It's interesting you use the very similar language that we're using in the course. I point out one of the intellectual failures of finance is we don't see clearly that banking is not just another private sector activity. We treat it as if it is. We pretend it is, and we pay bonuses as if it is, but then the reality is it's not. And I also I want to underscore something Peter said, just for those of you that are not that familiar with banking. I would say it even stronger. The risk that sunk Silicon Valley Bank is risk 101 for banking. Like, compared to what caused the financial crisis in 2008, this was as simple as it gets. If that was advanced physics, this is, kindergarten.
Yeah,
and,
absolutely.
And what shocked me even more is that apparently the stress test for interest rate risk wasn't even on the regulator's stress test list, which is beyond, I don't understand how that's possible for a bank.
Neither do I, and neither do many central bank colleagues in Europe. They don't really understand
where
how
that's
this
different. I assume that's different in Europe.
So I fully agree with you. It's almost kindergarten practice, what you should not have. And then it's the question, why is that allowed? What is the sort of reason that has been allowed? Because it is actually pretty simple to avoid if you do proper stress testing.
But I was, Peter and I were just chatting before the call here, and there's an article today out that showed that the bank's stress test was disclosed, I think today or yesterday, I forget. And it showed that the headline was Bank of America has a mark-to-market loss on their bond portfolio of a $100 billion loss, which is a stunning number. The exact same loss that Silicon Valley Bank, same exposure. They bought mortgage-backed securities, funded with their deposits. In this case, $100 billion is only 60% of their capital, not more than their capital. So it's a much bigger bank. But I actually spoke to a friend of mine who's a director of a different very big bank. And he said, but what they would say, and he believes they're correct, is that they have an assumption that they have a deposit base that is perpetual, and they essentially don't have to raise the interest rate they pay on their deposits either. So while the interest they're earning on this mortgage portfolio is now way below market rates, they're continuing to pay out interest rates on their deposits, which are way below market rates. And the analogy I gave to Peter is if it's like, your phone company or your internet provider assumes that you're not going to switch phone companies, even though they're gouging you on prices because it's a hassle to switch. That's essentially what's keeping Bank of America and these other banks from having to take those losses. And what triggered the crisis at Silicon Valley Bank is that they had a concentration of deposits from a bunch of Silicon Valley companies funded by Silicon Valley venture capitalists. And one of the venture capitalists picked up the phone and said, get your money. And so there was a run on the bank. But it just strikes me that the whole business model of banking is incredibly precarious, either way you look at it. And
yeah. No, that's true. It's actually pretty simple. If you have the license to call yourself a bank, somebody asked in the chat, what is a bank? Well, it's basically the license you get. And if you get a license, you are under the sort of safety net of the government indirectly, because there is an insurance for deposits. And basically that insurance allows you to attract money relatively cheap, as you were saying. And that basis will always be there. It doesn't really make a big difference if you are below the $250,000, if you go to the one bank or the other bank. And that is the main base for big banks to get funding. And there is a sort of not an incentive to offer more, because that is the whole sort of pool of money you can draw on. And on the other side, is more the question, what sort of risks do you take? And if you take such risk as some banks took and they sort of materialize, then you have time enough, exactly what your friend was saying, to recover over the years the money. What in itself is not a real business model in a free market. It's really a business model where you have the advantage of a government guarantee in a way on your deposits.
Which keeps the confidence to allow you the time to work your way out of the hole you've dropped yourself in, essentially.
And what you see now as a consequence, that I think there are three types of groups of banks. There's this group as SVB, what is quite an entrepreneurial bank making use of the market as much as they can. If they collapse, they collapse. It's very transactional what they do. They attract money and they make money. And as long as it's go well, they continue to be a bank. You have the big banks who are actually always a fallback scenario and sort of rely on the government support more even than the middle-sized banks. And then you have the type of banks I would really see as the real banking, what is the small community banks who are related, not transactional, but really related to their customers, and their customers know them, they believe in them. And they all also will continue to exist. But this middle group, who has not the full guarantee of the government, is really the group that is at risk. So I do feel that there is also a real call through this that banks become less transactional and should become more relational again to their customers. And that should be really supported, I feel.
And that's the again the interesting. It's not a coincidence, but the interesting overlap between our living systems framework, the principle I talk about is in-right relationship, and in my experience in banking, really from about almost the same time you started, Peter, a little bit later, I witnessed JP Morgan move from a relationship-centric bank culture to a transactional culture, kind of by both desire and necessity. At least that was the way we saw it. But throughout that time, and when you were in and then led Triodos, you carved out a very unique approach to banking, which was to retain that relationship-centric approach, and then began this whole network of similar banks, the Global Alliance for Banking on Values. And I remember I was privileged to give a talk in one of the GABV's conferences, and I put up on the wall the GABV principles and the living systems principles, and they weren't a perfect overlap, but they were highly similar. And so without intending to, you and your colleagues in what you call real banks evolved toward banking in such a way that was much more aligned with how living systems would suggest they should be. And there's lots of good research that shows that it's equally profitable and less risky to do that. So
what is interesting, we did in the beginning of the Global Alliance is for banking on values, what is now a network of almost 80 banks worldwide. We founded it in 2009. What we have seen, I think the profitability was about equal, the risk was not much higher, but what was interesting that the average big bank in the world only has 30% of their assets in the real economy. The rest is in money markets, is in bonds, is in all sort of things who go around the world. Where with the Global Alliance banks, we had 70% in the real economy.
Meaning real loans to
real loans, in
real
mortgages, in businesses. And that is, I think, much closer to where a bank should be. A bank should really be close to the real economy and be connected to that. And actually is a real health issue if you look at balance sheets of big banks, that are so much connected with each other and not with the real economy. Because the connection between them is an abstract connection. If you believe it, it's there. If you don't believe it's not there. But the real economy is there every day. It feeds people. It provides services to people. That is where the security comes for a bank, not this sort of abstract level, what is happening between banks. So I think we should learn about that and limit almost the possibility for banks to lend to each other and have this virtual money circus, so to speak, what can implode every moment.
But the banks will say, the trading banks will say, well, but we could never generate the return. Let me back up for a second. So one thing to say about these mega banks is that they actually now have a surplus capital requirement compared to the merely large banks. I think that's true globally. I think that's a BIS thing, right? So a JP Morgan, a B of A, a Citibank now has a very, very high capital requirement compared to pre-financial crisis. And it's not obvious to me how they make a return on equity on that much capital. And I think, one thing I know is that they view the return on lending as being substandard given how much capital they have to hold. So they actually make their money on transactions, economies of scales on processing transactions on a scale that is hard to even get your head around. But on trivial stuff like wire transfers and the like. But of course, then
I
they
think
rip us
one of
off on
the-
the wire transfers too.
Yeah, no, that's true. But one of the advantages the real banks have that they get a better rating from the agencies because they are sort of supported by the government. And there's lots of study being done, and I've sort of experienced it as leading a mid-sized bank. We had a lower rating because we are simply smaller and had not the obvious guarantee from the government.
Right.
A better rating means very cheap funding.
Right.
Being able to have big amounts of funding and use that with relatively small margins, but still margins to make profit. But it has nothing to do with value creation. It's simply the system in itself generating money, but that money is not coming from a real economy improvement. And that's the bad thing about the system at the moment.
And Peter, what happened? And I know you don't work at Triodos anymore, but I mean, when the Silicon Valley event happened, in your sense, what happened to the smaller banks? Were they in a panic, in a crisis? Was it fine? Was there a run on the bank? I mean, the bigger banks here, there were several of them that, I mean, what's it called? First Republic being the most obvious one, where there was effectively a spillover effect of the run on the banks. But what happened in these smaller global alliance type banks?
Not much, because I feel the reason is that they are so related to a group of customers, but on both sides of the balance sheet. And the point I made earlier, that they are really still intrinsically relationship banking. So people don't really want to leave that bank. They choose that bank consciously. So why would you leave it if you feel this is a type of banking I want to be connected to? So I think that was really an interesting observation we made in the Global Alliance, that didn't happen. And it did happen much less in Europe than in the US. I mean, I saw somebody will ask about the Swiss bank, Credit Suisse. I think that has another reason why they had a lot of internal management issues and problems with customers. There was not a structural issue with Credit Suisse, because they were basically doing the same business as UBS and Deutsche Bank and other banks, but they just had a series of, unfortunately, mismanagement things. And that, well, if there is a crisis, then that comes very quickly, because then nobody wants to invest in banks anymore, and then that is happening. So,
in fact, they had I forget who it was, one of their large Middle East investors sort of flippantly said, "Why would I ever invest more money in this bank?" That didn't help.
No, and then it doesn't help that there is a crisis, because that can be exactly the extra reason not to.
So it's the confidence. Confidence is hard to restore once it's put in.
And it didn't touch it didn't touch actually the other European banks. If it was really a structural issue, that would have happened, but that didn't happen.
Let me switch topics for a second, Peter, and put your central banker hat on now for a second. You made a comment to me last time we were talking where you said, I think you said, money used to be considered neutral. What do you mean by that?
That actually you have politics and you have money and you have people. That was the sort of old idea in society, and money was basically something in the eyes of many bankers, I think too, but particularly central bankers. We just have to manage that the accounts are correct. So the euro is the euro is the euro, or the dollar is the dollar, dollar. But let's see, it was more the element of money is what it is and not more than that. And if you want to direct it in a certain way, make it more environmentally supportive or socially more supportive, that is something politics should do. That should not be done with money through the banks. But what we have been developing also in Triodos Bank, but in the other banks, that money actually has a color. I mean, and you can give it a color. You can give it a more green color or a more red color, or whatever color you use. And because money is not neutral, it has an effect on people, it has an effect on the planet. And that whole idea that money is neutral and you should separate it from the political question is not any more valid, meaning that central banks also have to see, if we look at the system risk of the financial system, how much effect is there from the things banks are investing in? If they go more sustainable, indirectly, that will improve the security of the system. If they do less so, if they don't care, the system will be more volatile or sensitive to all sort of shocks. So I think the idea of money is a neutral thing. You can sort of make a calculation and something comes out and that's what you do. That's not anymore the case. You have to include these other areas who were considered in the past as more politically. And I think that's a good development and a very realistic approach to what you should do with money.
And it's also, the root of that separation is yet another example of our reductionist mindset that got us into this problem in the first place, and a very intentional separation rooted in neoclassical economics, where the economists essentially said, we don't want to deal with those thorny ethical issues. The political,
it's the externalities. You make everything an externality, and
we'll grow the pie. You guys figure out how to.
And we just do the sums, and that's it. Yeah.
But it also highlights a major flaw in the regulatory ideology. Bank regulation, and feel free to disagree with me since you're now sitting in a bank regulator, but my perception is bank regulation used to be primarily about making sure every single bank doesn't go bankrupt. It's very much of a one bank at a time approach. Then we had the financial crisis, and then, oh my gosh, there's systemic risk. So now bank regulation is about both individual banks being safe and sound and systemic risk, but systemic defined as the banking system, not the broader economy, much less the broader ecology. So again, we're still trapped in this reductionist mindset. And in many ways, the regulatory response to the financial crisis has made it more difficult for banks to do what they need to do from a true systemic risk point of view, such as make long-term illiquid loans for project finance on solar projects in Nigeria.
No, I think what happened, I think for a long time, central banks and politicians and economists didn't really think as the economic financial system as a system risk. They really looked at the system works, it's sort of a given. And if you watch carefully the individual players there and make sure that they do it correctly and honestly and fair, and then sort of it will add up in something positive. And the financial crisis made very clear that that's not anymore the case. So there was so much interdependencies in the system that if there was one or two rotten apples, very quickly the other apples were rotten too, and you had to do something. But what was a pity that instead of a real risk, system risk assessment, they made the individual risk management assessments even stronger.
Right.
So it was actually not a system response. It was making even the risk management better on the individual banks. And only in the last years,
but better as defined by single bank risk management.
Exactly. It was a sort of making that better, stronger, and it didn't help, of course, on the system risk. It helped the individual banks, what was okay, and some banks needed that, but on a system level, that was a next step. And that next step only came about in the last 2-3 years, where central banks start to realize that money is not neutral and that you have to look at the whole system, and that includes social and environmental questions too. So the system approach is not isolated to the financial system. It is the system in the broader sense.
And what's an example of how you see that progress? That's encouraging, first of all. I mean, I think that's very noteworthy. And I don't, is that a globe, would you say that's global or more of a European sensibility?
No, there is this new group of central banks for greening the economy, and they sort of work with each other on new methodologies to bring that into their sort of prudential but also system risk approach. And I think that's positive.
Mhm.
So where it was impossible 5-6 years ago to have capital surcharges for investing in fossil fuels, now is actually seen as a risk on an individual bank risk, but also they see it increasingly as a system risk. So something should be done there. So I think it's now much more a matter of conversation, not enforceable regulation yet. That's the next step.
Mhm.
It's a strong advice of a central bank, but not they can say this is what you have to do. But that will be the next step. I'm quite confident there.
Interesting. And I think it's worth underscoring, again, from my conversation with my buddy who's on this board, compared to when I was in the business, the rules and regulations of the regulators have a huge impact on bank strategy. Like it's sort of like you're handed the manual and then you figure out what you're going to do to optimize the requirements of the manual.
That's the other way around.
Yeah. We've placed a lot of responsibility on bank regulation to actually influence how banks allocate capital more than I think the public realizes. And there's some very smart bank regulators, don't get me wrong, but that's a bit scary because their incentives are to protect, they get fired when a bank goes bankrupt. They don't get fired when we blow up the planet,
Yeah, no, that's true. And what you see that the approach was more regulation, that the central bank became more the policeman on behalf of the government to make sure that the banks follow the rules.
Right.
It was not a risk-based approach. So all the nitty-gritty transaction of the civil society were also affected by that. And people got really frustrated. That is now changing step by step. And what you see with regulation is a more robust approach. So more capital for banks. Banks were really hesitant to accept that. So they accepted more this nitty-gritty regulation as an alternative, where actually they should have gone for the more robust approach. So double the capital requirements.
And then go do your thing.
And do a better risk approach in regulation. What saves you from all this transactional cost and burdens for people and for businesses. Yeah. So people start to realize it now.
Yeah, it is a burden. It's another theme that I hear from anyone I know. It's just, like
it's not in balance anymore.
Not fun to work in a bank. Let's switch again. Let me bring you out to you're a great grandfather in a rocking chair. The year is 2050, and you're looking back on the sector. What's it going to be like? What is it going to look like? What's the structure of banking going to be?
Well, I think there are a couple of things or more wishes maybe I have for that moment, and that I'm sure that they will happen. But I do feel that, first of all, I do not think that we have so many banks as we have today. So I do feel that the financing of the economy of people will be less and less only done by banks. In Europe, it's quite a big portion still banks. In the US, it's much less. Yeah, that will continue. That, by the way, will create new regulatory issues, of course, because at a certain moment, people also want protections for these alternatives. Yeah. So
by the way, just on that point, if I can interrupt, again, I've been doing some research for the course, and it blew my mind to see how big the credit funds have grown just in the last couple of years. Relative to the bank. I mean, you could almost say that banks don't make loans in the United States anymore. The credit funds are the real lenders. But anyway, keep going about your.
Yeah, what is in a way. in a way a pity, because what you see in Europe, at least, that the banks were as a real ecosystem. They had some big loans where they make more money on, and therefore they could help the SMEs finance.
Yeah.
The moment the sovereign funds come, the big funds, and take out the nice portfolio of the big loans, then the bank gets stuck with the smaller loans and they cannot service that anymore. Yeah. So the ecosystem, what is an altruistic system in the economy, what I think is very healthy, is being by this sort of neoliberalism sort of thrown apart. And in the end, all the small business has to be supported by the government, what has to be paid by the taxpayer, of course. So we get a very inefficient system in the end. What looks very smart in the beginning, but it isn't in the end. So that's one development. So what I hope that in 2050, we have sort of banking type organizations who have to really sort of make clear that they have a balanced portfolio. They have to do some in social banking. They have to do something in mortgages. They have to be taking care of sustainability. So they have a healthy portfolio, and that is where they will be assessed on. And of course, we have to see that the relation between the real economy and the financial sector is more in balance. So for the regulators, that will be the big question, the monetary question. How do you regulate the balance between the financial sector and the real economy? So that not only 30% goes to the real economy and the rest is in financial markets. How to bring that back to a reasonable percentage? That will be one of the big questions for the next, 25 years, and to see how we bring that more in balance, so that banking and finance will be really in service of the economy of the people and not the other way around, what is happening now.
You know, it gets us back to the beginning of this conversation, where what you're calling for is regulation that is purpose-driven, not analytically driven, and that purpose is this public-private nature of the role of banking.